If you're self-employed and you haven't filed your taxes yet, the IRS already has your 1099s and they're building a case against you right now. Here's what most gig workers and freelancers don't really understand about unfiled tax returns. Here's the deal. The IRS knows way more about your income than you think they do. See, every payment app, every platform, every client, they're all reporting your income to the IRS. And when you're self-employed, the consequences hit differently. They hit harder, faster, and it gets more expensive real fast. Here's the problem. Most people think that they didn't get a W-2, so they're somehow invisible to the IRS. And that is completely wrong. In fact, it's actually the exact opposite. Today, I'm breaking down exactly what happens when 1099 workers don't file and why it's worse than regular employment, like tax problems, for people who work on a W-2. Every payment platform reports to the IRS now. So here's the part that nobody really tells you. The reporting requirements changed dramatically very recently. It used to be you needed to have $20,000 in payments. Now, just $600 triggers reporting. So PayPal, Venmo, Stripe, Square. If you received over $600, they sent the IRS a 1099-K. And here's where it gets worse. Uber, Lyft, DoorDash, Instacart, they're all filing 1099s too. And your clients who paid you for freelance work, they'll file the 1099 NAIC. So you thought that side hustle that you do was under the radar, huh? Not quite. So here's where people get this wrong. The IRS gets these forms by the end of January. And you might not even get your copy until February or March. But see, the IRS already knows. So these companies have to file with the IRS first. So while you're thinking, maybe I can skip this year, the IRS computer is already flagging your account. Every missing return gets logged, and every unreported 1099 creates a mismatch. And that mismatch triggers their automated system. This is the mistake that causes everything else to happen. So people wait. Their 1099s, they're figuring it's gonna come in sooner or later, and they decide whether or not to file based on that. But the IRS isn't waiting. The computers are already matching what they received against what was filed. AI in action, right? Then when nothing shows up from you, that's when the problems start, because most people miss this completely. So when you're self-employed, you're not just facing income tax based on your income, taxable income. The killer that most people don't really understand is you're facing self-employment tax too. That's an extra 14.1% right off the top. So if you're in the 12% bracket, add that 14.1 to it. Let me explain why this matters so much. With a regular job, your employer pays half of your Social Security and your Medicare. You pay the other half through withholding. That's the 7.65%. But when you're self-employed, you pay both halves. Now, Congress decided you're only going to pay 92.35% of that 15.3%. But the part that destroys people is that when you don't file, the IRS doesn't know what your expenses are. So they assume zero. It's all profit. Every dollar becomes taxable. No deductions, no expenses, no mileage, just pure income hitting the tax rates. At $50,000 in gross receipts, they take it like you kept every penny, even if you spent $30,000 running your business. This is where unfiled return become catastrophic for self-employed people. Think about what that really means, because there's penalties and there's interest on top of it. A regular employee makes $50,000, might owe $6,000 to the IRS in tax. And a self-employed person with $50,000 in gross receipts with no deductions, where they're looking at $76.50 just in self-employment tax, plus income tax on top. So that could be 15 grand or more. And here's what most business owners miss. When you don't file, eventually the IRS files for you. And this is where people lose control. It's called a substitute for return, or an SFR. And for self-employed people, this is a complete disaster. Let me go over it. This is how it works. The IRS takes all of your 1099 income and creates their own tax return. But they don't know your business, and they don't know that it costs money to make money. In reality, they don't know your expenses. All they see is just the income that was reported to them. Here's what I see all the time. A driver made 40 grand on Uber. After gas, maintenance, depreciation, maybe they netted 15,000. The IRS taxes the whole 40 grand. That's $25,000 of phantom income getting taxed. And in a freelance project where you subcontracted half the work, the IRS taxes the whole amount. So your client paid 20 grand and you paid out 10, doesn't matter. They taxed the whole 20 grand. Those business loans, those meals at home office, equipment purchases, They don't exist in the IRS calculation. Now here's the part that actually matters. Once the IRS files a substitute for return, it becomes your starting point. Now you have to prove why their numbers are wrong. Instead of just filing a tax return, you're fighting their tax return. And this is the mistake that causes the problem. People think they can wait and file later with their real numbers. But once the IRS files for you, everything changes. It is considered substantially correct, and your debt is established. From there, collection starts. And now you're playing defense against offense. And most people don't understand this until it's way too late. So file your taxes on time. That's the only thing I can tell you. Because the IRS treats self-employment tax way more aggressively than any other tax. And here's why it matters so much. With a W-2 job, at least some of the tax was paid through withholding. You see, the employer sent money in with every paycheck, or at least monthly. With 1099 income, you didn't make quarterly payments. They see zero compliance. Nothing paid, nothing filed, no effort to comply. This is where the IRS starts paying attention really closely, and then they get their game plan on. They move faster with enforcement, liens come up quicker, levies hit harder, bank accounts get frozen without any warning, and W-2 employees get off easier because there's no employer for you to levy, so they come directly after your assets. And here's where the problem gets worse. Self-employed enforcement follows a different timeline. Regular employees might get 3 to 4 notices before serious action. Self-employed in the era of AI, the IRS knows you're the only source of payment. No employer to garnish wages, no steady paycheck to levy. So they move in with asset seizure faster. And that's where most people get hurt. They think that because they have a friend who got a W-2 job, they got multiple warnings, that's going to apply to them. But with self-employment, cases escalate very differently. Most self-employed people who didn't file also didn't make quarterly payments. This is a double problem that most people miss. Not filing is one issue, that's your 1040. Not paying quarterly taxes is another. And they compound on top of each other. Here's the reality, and I don't want you to miss this. The IRS expects self-employed people to pay as you go, 4 times a year. You're supposed to send in estimated payments, and when you don't, additional penalties stack up. That's the ticket. So every quarter you missed adds more penalties. It's called failure to pay estimated tax. And those penalties hit even if you actually file, or eventually. But if you pay everything when you file, you still get the penalty. Because the IRS wanted their money quarterly, not annually. Missing 4 quarters, that's 4 separate penalties. On top of late filing penalties, on top of late payment penalties, on top of that is interest. This is the compound effect that destroys people. So let's say you owe $10,000 in taxes. Failure to file penalty, 5% per month up to a maximum of 25%. Failure to pay, 0.5% per month ongoing. Failure to pay estimated taxes. That varies, but it's between 3 and 6%, and interest currently over 8% compounded daily. So your $10,000 becomes $15,000 real fast. So you'll wait a few years, it'll double. People think, I'll just catch up later. But later comes with thousands in extra penalties. And the penalties on self-employment tax hit harder because the base amount is a lot higher. Here's where people lose complete control of their taxes. 1 unfiled year turns into 2. 2 turns into 3. And each year, those 1099s keep getting reported for you. The IRS keeps track and they build your profile. Each platform, each client, each payment processor, they're all filing forms. The IRS data pile just continues to grow. Meanwhile, you're falling further behind. The average self-employed person I help, 3 to 5, maybe 6 years go unfiled. Started with 1 overwhelming year. And maybe because business was crazy, maybe records were a mess, they figured they'd catch up next year. But next year brought new problems. Now they're looking at 50 grand, 100 grand, sometimes more. Not because they made such a profit, but because the IRS calculated tax on gross receipts for multiple years with 0 deductions. So here's what really happens. Year 1, 40 grand in 1099s, maybe $15,000 in actual profit. IRS calculates tax on 40 grand. Year 2, $45,000 on 1099, $18,000 profit, IRS tax is $45,000. Year 3, $50,000. You net 20 grand, the IRS tax is 50 grand. What do you owe now? The IRS calculation is $135,000, plus self-employment tax on top of it all, plus penalties, plus compounding. This is how a middle-income self-employed person ends up with six-figure tax debt. This is where the panic sets in. So if you're a self-employed person with unfiled tax returns, you need to understand these critical three things. First, the IRS already knows about your income. Ta-da! Every 1099 is in their system. Every payment platform reported you. So every client who deducted your payment told the IRS about it. Second, waiting makes it worse exponentially. Not just linearly, it's worse exponentially. The penalties compound. The interest compounds. The IRS substitute for returns compound. Third, you probably owe way less than what the IRS will calculate without you. So this is crucial to understand. Your actual tax on actual profit is one number. The IRS calculation on gross receipts is completely different. Often 2 to 3 times higher, sometimes worse. So here's what I would do if I were you instead. Get your actual numbers together, your income and your expenses. The 3 P's, proof of purchase, receipts, proof of payment, bank and credit card statement, proof of business purposes. Your expenses, essentially. Mileage logs, even if you reconstruct them. And then receipts, if you have them. But don't let a perfect case be the enemy of the good case. File your returns now that show an actual profit, not just gross receipts. The difference will be massive. Last week, I had a client who showed $180,000 of income over 3 years. The actual profit after expenses was $58,000. That's $122,000 of phantom income that they were about to get taxed on by the IRS. So stop thinking you can wait this one out. The IRS already has all the data they need to tax you. And every tax season that you pause things, they build a stronger and stronger case. And their version of your taxes is always worse than reality. So start gathering your records now. Bank statements going back to unfiled years, credit card statements showing business expenses that you took that were actual. You got to take mileage logs on your car, even if you have to reconstruct it. Date, destination, business purpose, beginning and ending odometer readings. Any documentation you have of business costs, and even partial records beat no records at all. Because here's the truth. Filed returns with reasonable expenses beat IRS substitute for returns every time. Most self-employed people can out-calculate their tax return, maybe by half or more, by doing the actual returns. But you've got to act before the IRS locks their numbers in. Once they assess the tax based on their substitute for returns, everything gets harder. If you're self-employed with unfiled returns, you need to talk before the IRS files those returns. So visit besttaxpro.com to understand your full risk. Don't let the IRS version become your version of taxes, and then that's your reality. Because the longer you wait, the fewer options you're going to have.